Large moves on the 10-year. They have pushed yields closer to uninverting, but that might not be a good sign for the economic outlook. Yahoo Finance's markets reporter Josh Schafer is here with a closer look at the recession indicator. Hey, Josh.
Yeah, Brad. So I spoke with the founder of the recession indicator last night, Professor Campbell Harvey, and I asked him, what happens when these yields uninvert? You remember back since last November, we've been talking about the inverted yield curve, meaning that yields on the three-month Treasury have actually gone below what we see higher than what we see on the 10-year Treasury. So that's been inverted, that yield curve. But what happens when we uninvert? So if you look right now at the inverted yield curve, right now we're showing you the 10 and the 2-year, and you can see that it's getting closer and closer to uninverting at the end of your screen on your right there. But what's interesting here is what's happened before the last 4 recessions, those gray vertical lines we have on our chart here. Before the last 4 recessions, we've actually seen the yield curve uninvert. So what happens when it uninverts, and the key to understand here that Professor Harvey was talking to me about, is why it uninverts and why we're seeing the yield curve potentially uninvert now or in the coming weeks. It is not uninverted yet, would be the move in the long rates. We've seen a big move in the 10-year yield. What they call this is a bear steepening. And what we're talking about with that, of course, bear and bull. Bear not normally good for stock investors, right? And Professor Harvey gave me basically 3 specific reasons why the bear steepening and that rise in long rates is not good. So for one, it's the most closely related rates to consumers and businesses. So it impacts both consumers and businesses, because when we're talking about long rates, we're talking about 10s, 20s, 30 years. Well, what's the most common 30-year rate we think of? We think of a mortgage rate, right? That highly impacts consumers. It's also going to cost more for businesses to get loans when they come back to market over the next couple of years. That will shrink their profits. If their profits shrink, they might have more layoffs. So that's something to think about. And then again, the long-term lagging impacts is something we keep talking about with these yields. When we think about long rates and those being long-rated interest rates that people are taking loans out on, Professor Harvey was kept harping on the fact that that's going to be something that we don't see necessarily right now, but something that we're going to see coming down the pike. That's what actually has him in the camp of he thinks the central bank should be talking more about rate cuts right now than rate hikes, which also stuck out to me.
All right, Josh, great job analyzing all of that and really drilling down to exactly what this could mean here, not only for the broader economy, but also for our viewers, for our consumers. So thanks so much, Josh, for that.